Okay, over to you then.
Yep, thank you. Thank you, Emma. Hello, everybody. Today we're going to have our another webinar dedicated to methodologies of taking trade credit decisions. Sorry. Today we're going to be considering actually the key topic of I think of the whole credit management as well. But first of all, let me thank you. Let me say thank you to everybody who came over, and to everybody who will be watching it as a record. Let me start with my usual gratitude to the people and organizations who made that webinar possible, which is the Credit Info Academy and Credit Info as a whole, which is also the Association of Credit for Central and Eastern Europe, where I'm taking care of development, and Polish Institute of Credit Management. So special thanks to that, and personal thanks to Emma, who is taking care of all of the technical stuff and does a fantastic job. So thank you very much for having me here and for this ability to share my experience and knowledge with the audience. As I said, today we will be considering as in a deeper details the credit term. So actually the key elements of credit management. If we have a look at the slide which you see on your screens, which is dedicated on the methodology, how do we take a trade credit decision? Let me remind you about that, and maybe explain to those who didn't see previous webinars that actually the smart trade credit decision is coming from comparison of credit worthiness with the credit demand. We take the credit worthiness, which is reflected as a certain amount of money, and then we compare that with the credit demand, which is the amount of money we need to give to our counterpart in order to achieve the objective we set, either it is higher volume or specific volume, or market share, whatever it is, we need to give to provide a credit of certain amount to our counterpart, and we compare that with their credit worthiness. So actually, the amount of the credit demand will be hardly dependent on the two key components. First one would be the turnover, or let's say forecasted sales we would like to achieve, or which is supposed to come out of transaction. And the second one would be the credit term. Actually, the period of time we allow our counterpart either use our financial resources in case of providing advance payment to a supplier, or if we're talking about delivering of goods and we're talking about the customer, this would be the period of time between the actual delivery and the payment date, the date of the payment. And then there would be either contractual payment term and actual payment term. This is the subject to another discussion, but the contractual one, this could be the 30 days or 15 days or 180 days or somehow combined payment terms. But what is important here is that we're supposed to understand how much time we allow our counterpart either not to pay or not to deliver goods. So what is the actual time, which is we call the time of credit. Why I say that it stays very deeply in the essence, because if we look in very deep details, we will see of a credit transaction, we will see that it is actually impossible to coincide perfectly the two events, the event of payment and the event of delivering of goods. There would be always a time difference. That's why I always say there is, majority of financial people say that there is credit in any transaction, which would be true, because it is impossible to coincide these two events. There would be always a credit given by one party to another one. Again, we are using consciously the credit term in order to achieve our objectives, our business objectives. In majority of the cases, we consciously use a credit term in order to achieve higher sales volumes or higher turnover with the customer and make higher profit. This actually would be the main topic. So this is actually his, or I don't know, maybe Her Majesty credit term, which stays deeply in the essence of every credit transaction. So when we take a credit decision, and in majority of cases, we actually take two main decisions. To give or not to give credit, which would be in the essence a credit term, either provide advance payment to a supplier or give a credit term to a customer. And this is actually the key decision we're talking about, because here there would be we give credit or we would like to get credit. Sorry for confusing. This might sound confusing, but in any transaction we either give or provide credit. There is no third. There is no third way to do so. So in our case, looking at our counterpart, we decide whether or not we will provide them with the credit. And then there is second question: if we do give credit, how long the term should be? How long we would allow our customer not to pay? Again, we were discussing, these are actually two key components, because, credit itself helps us as a sales tool to achieve higher volumes, to achieve our objectives, but it has a price. The price actually dual, which is credit risk, because we take the risk in most of the cases, whether that customer or customer won't pay or supplier won't deliver the goods. And then there is second one, because financing has a cost. We know that the concept of cost of money in time is always applicable to this waiting. Obviously, there is no waiting if it is just within one banking day, but since we are talking about second or since we're talking about first day of credit, there is cost of waiting. So each time we allow our customer not to pay, and we are shipping, or in other words, we are shipping goods without present payment, we take a cost of waiting. Sometimes it's invisible, but in very general concept, we consider that as a loan at the cost we normally finance. I won't be touching, I won't be going here with deep details. If you've got a question, please raise your hand. I will touch that deeper if necessary. So far, I consider that quite obvious concept for everybody involved into credit. So again, the first question and the first decision is mainly concerned with the credit risk, whether or not we will be taking the risk or we've got a coverage and we go ahead. And then second question is how long this term should last. And actually the second question is actually the topic what would be the payment term, what are the factors, how can we find the balanced credit term to work with our counterpart, how long this should be. Well, there are a couple of, I would say, not like golden rules, but points which are always applicable each time we decide to provide our counterpart with a credit term. Well, first one is we always to remember that credit term is a discount, discount is a credit term. So each time we provide a credit term, in any form of credit, we give a discount, or each time we get an advance payment, we receive a discount. So this is supposed to be somehow, actually supposed to be included into the price calculation. The only difference is actually a credit risk. So credit term could be perfectly a discount, only in case there is no, credit risk is not subject of the discussion. For instance, if it is covered by the bank guarantee or something like that. But that's topic of the credit risk. So again, if, for instance, in practical terms, it would be very often, it is much more, I would say, much more practical to ask customer for advance payment, reduce the price, and avoid credit risk if we see that, customer financial profile doesn't seem to be very strong. That's one practical example, or actually one conclusion of that. And then second thing is, it is important to remember that credit term is a discount. So each time we discuss the price, we need to keep in mind, with the customer, with the counterpart, we need to keep in mind that this is the price with a specific credit term, or this is the price stated is actually related to prepayment, on prepayment basis, on the payment term. So each time there is a consideration or reconsideration or review of the payment term, there should be price involved. Or each time price involved, it's supposed to be this, payment term supposed to be at least mentioned. I do know that it is not very easy to come to customer where we, or to the supplier where we already discussed the price and you then change the payment term. This could be the case. Obviously, we need to negotiate, and sometimes it is difficult. But what I try to suggest is, each time there is often a situation where payment term is fixed, especially when we're talking about very powerful customers like retailers or someone like that. So we fix payment term, and then companies start to discuss the price. You need to think twice before you enter into that discussion. And again, if there is a significant requirement for significant change of the payment term, the first thing to ask, what about the price? Well, because of that, to give you practical case, once I had the discussion with my friend who has his own business. And he used to be supplying a quite big multinational, and they say, my customer wants 180 days payment term. So I thought, that's good, but anyway, it's quite big business. But how much money? What is your profit margin? He said 10%. I said, okay, very good. What is the interest rate? You are using resources on. He told me that's 30%. I said, look, on 180 days payment term, this means that you're supposed to pay an interest of 15%. This means that you're gonna be working on -5% profit margin. Is that interesting for you? The answer is just just as obvious. So again, payment term is a discount. Discount is a payment term, just like that. Now let's go to another rule, which is credit term without limit is as bad as, limit without credit term. Again, this is practical sides of the payment terms. Well, normally, if you remember, the credit setup consists of the three main things: credit limits, credit term, credit limit, and security requirements. Security requirements is actually kind of subsequent or secondary thing to the topic, but credit limits supposed to be in harmony with the payment term. So, for instance, if we say that our customer buys from us, let's say $1,000 per month, and we give them a payment term of 7 days. This means that every single portion of goods they purchase from us would be supposed to be paid in 7 days, and then we give them a credit limit of let's say 100,000. This means that, and imagine they are purchasing one time per week. So this means that in order to stay within the credit limit with a 7 days payment term, they have to pay us, for one portion which is expected to be 250,000 or 250. This means that they have to pay something in advance. In such a situation, if the credit limit is too low, is not corresponding to the credit term, this would mean that our customer would never use their payment term in full. Or in other side, if the customer's credit limit is quite big, but the payment term is short, so even in the same situation where we've got like 1,000 per month, and the payment term is only 7, and customer pays, but they won't have an ability to use their credit limit because the payment term is very short. So they're supposed to stay somehow in harmony. It's not very big deal to find that harmony. We will be looking at it in our next webinar in more details, where we will be discussing the assessment of the credit demand. But again, if it is unclear or you've got questions, type them on chat, and if so far there are no questions, let us go ahead. Practical example of that, in my practice as a corporate credit manager, was very simple. Let's say New Year, end of the year, New Year, holidays, we are an FMCG companies, and there is an excessive demand of goods in the end of the year because there would be holidays during which we won't supply, and sales team is coming to a credit manager saying, we need higher credit limits because the purchase from customer is supposed to rise up, and we need additional credit lines. We discussed that, customers are provided with additional credit lines, but on the other side, that credit term remain the same. Then we entered January, and we started to collect money, and then customers say, sorry, we are not ready to pay because the goods are not sold yet, because we were delivered an excessive amount. So again, payment term without credit limit. So customer didn't pay. Then we started, difficult discussion about the overdue, where the situation was, was very easy to predict, because we do understand if we send excessive amount of goods to our customers, they won't be ready to pay because they got a certain amount they normally sell themselves, so there won't be lack of cash. Well, these are more or less two rules, much more general ones, and then we have a look at, let's say, majority of factors. So before we start thinking about the giving of credit terms to our customers, we need to think about the main factors which are applicable and which are affecting the credit term, at least in the trade credit. Majority of these factors are explained in the literature. I don't try to replace, good books like, Credit Management Handbook, or, like all the materials of the Chartered Institute of Credit Management, where it is, very perfectly explained. I just want to mention, most important of them, and as you see here, they somehow look at pairs because we've got 8 factors, and sometimes, they are balancing each other. For instance, let's look at law and the product. As you know, in the Europe now there is a law which is restricting payment terms. So, for instance, for the local transaction in France and then in Germany and in Spain, there is a maximum of 60 days payment term. On the other side, there is a product type which could dictate the length of the payment term. I mean, not going too deep into details. We all understand that, the milk and yogurts won't have the same payment term as cars or industrial goods, because it would be quite out of common sense to sell dairy products at the payment term of 60 days. At the same time, 60 days for the cars or for kind of industrial goods or machinery equipment, 7 days won't be considered as the payment term at all, because length of the use of the goods or their shelf life is absolutely different, and again the cost of single transaction is quite high. Another important thing to consider is the pair of profit and the interest rate. In the example I just given above, all of the profit of the company or of the transaction, all of the profit on the transaction which company makes can be exhausted with the interest rate or cost of financing. Again, it would depend on the on the interest rate itself. In country like my friend lives in, there was example from Ukraine. The interest rate is 30%. In Europe, in Switzerland, it hardly reaches 3%, so it would be different view. Again, companies make different profit on their transactions. Some companies make 10%. Some companies got quite high margin, and profit margin could be even 10%, 15%, 30%. But at the same time, companies like traders, they do hardly make 1% on their transaction. So for them, providing payment terms is quite hard exercise, especially if we take into account that then after the contractual payment term, customer may pay later. So all of the profit may go away quite quickly, just because of the payment term. Well, again, another, as we said, credit risk could be a defining term, but normally the higher the risk, the shorter the payment term should be. At the same time, we've got competitors. We always got competitors, and it's especially in the in fast businesses like trading and like I don't know, FMCG, if you want. There is quite high competition, and if we don't fill the order of our customer, there are our competitors who will do, and then we are ending up in the situation where our competitors took the risk, but in the end customer paid. or again, we might take the risk that customer won't pay. So the decision is not that obvious. But again, we are somewhere between risk of being non-paid and the competition. I think that's the quite hard line, or let's say, if not the hardest one to consider. So we need to consider what payment terms are given by competitors, and then we need to have a look at the risk profile of our counterpart, and then we have to decide, how much money we put under risk, how much money we earn, and then simply be honest with us and with ourselves, and take a conscious decision. Again, if all of our competitors provide 30 days payment term to nearly every customer, we cannot come with 15 days payment term or even cash terms, unless we provide or unless we offer a very good price for that. So all the customers will come to us. Again, lower price would mean if it is still profitable to us. Another line, the last line to discuss, is actually our market share or our market position and the cash cycle. We will be looking at the cash cycle, in the last part of our today's webinar. Market position or bargain capacity or negotiation power is actually one side of the story, because like the story about the law, which actually came over in European Union, these regulations after the crisis of 2007-2008, where suppliers to retail chain came to the legislators and said, ladies and gentlemen, you need to interrupt. You need to find a solution, because we cannot really survive if retailers will continue to insist on extremely long payment terms, like 150 days, 180 days, where at the same time, cash cycle where we take the length of the goods staying in inventory and then receivables, and then we subtract from that the payment term, so it is become negative. So for instance, in that time, at the time supplier like retail supermarket chain were asking for 180 days payment term. At the same time of delivery of the goods were say 7 days, and then I don't know, maybe 3 weeks or maybe 4 weeks, 1 month, goods were laying on stock, maybe another 2-3 days to do an accounting exercise. So here all the cash cycle was taking only 30 days for the supplier. So that means that 140 days, they were simply using this money as a cheap, or let's say free financing, which was not fair, because first of all, 140 days is too long. It's not balanced. It is not, explained by anything. And at the same time, the cost of this 140 days was directly subtracted from the profit of the supplier, just because of what? Because of negotiation power or bargain capacity. So it was balanced with the law. Well, when we decide, or when we negotiating, we were actually naturally we came to the topic of negotiation, and here we are talking about, again, there are different factors to consider, as we said, all of them like profitability, but in the end we end up with the tug of war game between the buyer and the seller. In the center of the slide, you see the components of the cash cycle. As we say, there is a time between the, goods are shipped by the seller, so there would be some time for the delivery. Then there is some time, if it is export transaction, taken by custom clearance. Then there is some time when the goods are laying down on inventory, on buyer's warehouse until they sold. Then, the buyer delivers these goods to his own customers, and then there are some credit terms provided. Could be, it's not necessary that all of these elements are, we will be in each and every specific transaction. Some of them will be missing. And also, there might be some additional points. For instance, delivery can be longer, loading, uploading, some specific, inspection time could be also included into that. But that's actually the whole cash cycle between the time the goods or, deliver it to a customer and these goods, and actually these goods or let's say the buyer receives the economic benefit out of these goods and convert them into cash. Or if in terms of service, it could be a little bit different, but more or less, again, there would be a cash cycle between the service rendered and economic benefit came to the buyer, so supplier pays. And then, this tug of war starts. So both over the negotiation, the seller wants this term to be shorter, to be, to go down on the chain and receive the payment from the buyer as early as possible. Again, that could be also the case with advance payment could be the case, where actually the point of delivery, or let's say point where the seller receives the cash, is below the blue line in our scheme, and the buyer tries to pull it in different direction. What I try to say, each time the payment moment would be outside, let's say, on top of the orange line, extremely on top of the orange line, or below the blue line in that graphical explanation. That's kind of unfair. Again, there is always a good reason for both. For instance, buyer in a difficult financial situation can be provided with a longer payment term from the seller side, who doesn't want to lose the customer. The same story if the buyer needs to secure a certain delivery and make sure, everything's okay with the seller, or supplier requires some financial help, and this is done on the mutual agreement. This could be done, but again, this is supposed to be done consciously and on mutual agreement, with the clear understanding why this is done, and the reason, and again, if it is exception, what is the time limit for such an exception. Well, this is more or less everything I wanted to share with you today about the credit term, because the topic is extremely deep and extremely interesting, and well, I won't be surprised if you don't have questions, but I will be happy to answer if you've got any question about the credit terms, about what we discussed today, or maybe something else about the credit management itself. So please, the floor is yours.
Guys, you can put the questions in the chat box, or you can unmute your microphones. Alternatively, Andriy, as usual, I'm sure you'll be happy to receive any emails.
Absolutely.
And
Absolutely, with no restriction. Either email, or you can find me on LinkedIn. Or please, there is my phone number, there is my mobile number. Please feel free to call to ask your questions. I will be happy to help as much as I can.
and I think your contact details are on the next slide and on the first slide as well.
Let me double check. Yes. So just to make sure it is recorded. Yeah, you can find all of my contact details over here on the slide, so you can see it. Feel free to contact me anytime you need help about the credit management.
That's perfect. Well, Andriy, that just leaves me to say thank you. As usual, an interesting topic, and as you said, it is quite in-depth. And just as a reminder, everybody, the next session, number 6 in the series of 7, is on Thursday, the 26th of October. So we'll send those details out soon, and they'll also be on the Credit Info Academy website and social media. I've just had a question sent through. So,
Yeah.
can scoring products enhance bank performance in terms of selling with higher interest rates?
May I ask what does that mean, scoring products? Or can you please repeat, because I'm not quite sure I understood the question.
Okay, I'm going to pop it in the chat box for everybody.
Yeah, if possible.
So
Scoring product enhance bank performance in terms of selling with a higher interest rate.
So like our scoring products.
Well, if I understood correctly, again, I'm not sure. Please contact me directly if my answer won't be clear. The key question would be what do we understand under the higher under the bank performance. So if whether or not the scoring product or credit risk assessment product is adding to profitability of the bank. Again, yes, it is supposed to, but scoring itself is actually assessment of risk. It is not a credit decision. If it followed to, and if the bank is taking care on both sides of the story, selling more, and that's one side, and another one is taking care that all of the loans they provide, all of the new loans they provide are actually paid, so there is reduction in default, or reduction in default rate in practice. Yes, this adds, and selling with in a higher interest rate. Again, this is the banking itself is a little bit different from the trade credit transaction. Because in banking, the credit is a product itself. It is not like a supporting service. It is not without discounting the importance of the credit term. So if we try to sell at the higher interest rate something based on the scoring, I don't know if it will be competitive, because here we are talking about competitiveness. The benefit of scoring, in my opinion, is pretty simple. We simply take the faster decision. And this actually benefit, whether or not it's supposed to be driven by interest rate. Normally, to the extent I understand the interest rate situation is actually interest rate is dependent on the risk of the customer. So the higher the risk, the higher is the interest rate, and which is compensating us, compensating the bank for the situation where customer won't pay in the end. So we kind of self-insuring ourselves. So again, there is no straightforward answer to that. So scoring product is certainly the thing which is needed to be implemented again, which supposed to be again profitable from the bank capital point of view, because the better scoring we've got, the lower would be the level of reserves and the capital we put in place, and again, the lower the cost of credit for us it would be. Sorry if I sound confusive. Again, contact me directly if you want to discuss the topic. I will try to understand, but again, I'm not sure I understood the topic directly or clearly.
No, I think that was a good answer, Andrei. I think from what I understand, that we understand that. I have another question. Just bear with me. I've just popped it into the chat box.
Yeah.
Do you think that automated credit process could generate more profit for banks, especially by offering small loans to well-scored clients? So it's not really quite with the trade credit, but it's
it is credit question. It is credit question. Thank you very much for thank you very much for it, because well, automated credit scoring is I think the methodology of that pretty surely proved its its efficiency, because automated credit process is actually helps us to take fast decision, or quite fast decisions, and helps us to speed up the business with the customer. And customer, nowadays, people can come, fill in the questionnaire and got the answer what credit they could have. And in this way, so in terms of volume, because we were talking about what is the profit depends on the two things, maybe three things in respect of this question. We've got the volume of transactions, we've got the margin on every transaction, and then we've got default rate, which is deduction of the profit. So the faster we do business, may make us, our speed of doing business can help us to do more transactions than our competitors, so we become more competitive, we've got higher sales. Again, since the better our scoring, the better our predictive model is, the less defaults, or the default cases we have. So again, our profit would be higher. The only question to think here would be about, again, it's a question to the model itself, because normally when we are like finance and credit people, we are considering the effectiveness of the model. We normally tend to consider only the side of the defaults. But we also need to keep in mind, we were discussing that on our webinars, we need to consider the so-called type 2 error. So when our model, so type 1 error it works directly. So for instance, if the model says the risk is high, or there is very high default rate, and if we give a loan to this person or to this company, and there is default in the end, yeah. So this means that this is kind of I'm sorry, that's a little bit different. So the model says the risk is good, we give a loan, and then the customer defaults. This is so-called direct or type 1 error. But there is also type 2 error, where where the model says that the risk is bad, and in the end customer pays, and in the end customer survived and pays the loan. So which is the case where the model is actually not leading to the losses in terms of defaults or bad debt write-offs, where the model leads to the loss of sales. Again, what amount of sales, whether or not we are able to assess that amount. I still think that there is no perfect model just because it is statistical, and it is impossible to predict the future in any way. But anyway, again, if we compare the situation, since in this question accent is put, emphasis is put on the word automated credit process. Yes, exactly. If we will be slow, and if we will, especially with the things like consumer loans where the volume is very high, if we try to do everything with the hands without automated process, we can, the bank can easily become uncompetitive and lose all the sales, all of the money invested into that portfolio. So again, in general, yes, that's nearly obvious that automated credit process generates more profit for banks. What will be the moral approach? Maximizing or optimizing interest rate? Well, interest rates. Well, I don't think I'm allowed to go that deeply into the banking sphere where I am not really an expert, because our topic is actually trade credit transactions. But again, if we imagine that this is hire purchase and this is still trade credit, interest rate is a way, is one of the balances which is actually a competitive instrument. I think, again, since this is the payment term or the discount, I think it's more question to the competition and the credit risk. So again, we have a look how high the interest rate could be, and then they look at the risk of our portfolio, and then they take a decision. There is no obvious answer to that. It's a question of modeling of your portfolio mathematically, and have a look. Okay, here is the risk of our portfolio, and here is the performance of our portfolio, and then you do your calculations, and then you keep fingers crossed and try it practically. I don't think there is somebody who can give a direct answer. Simply it could be high or low. Thank you very much for agreeing with me, because credit management is not a precise math. Each time, like finance itself, yes, obviously we will take care of sending out all of the links to the previous webinars, and thank you for all of the things. Just to wrap up, since we've got 2 minutes, and to finish the thought I wanted to say is, when we talk about finance and the credit management is part of finance, we are talking about, we are dealing and we are looking at the future. As soon as we enter, as we look, and as soon as we start looking at the things from now and into the future, we must forget all of the precise math, all of the precise numbers, because it is accounting which is dealing with the past, and in accounting we've got precise numbers. in the future. We have nothing to precise. We are entering the territory of uncertainty. So we can try to to preview, to estimate as much as we can, but nobody knows the future. This is the only ultimate truth. So things can go in either way, despite all of our calculations and assessment. We can only estimate, and we, just like used to say, that everything we got is the hope that our best is enough for what we need. This is it so far. Thank you very much to everybody for coming, and we will see each other on the next webinar. And again, contact me directly if you need me anytime. Thank you.
Thank you, Andriy. Thank you, everyone. See you next time. Bye-bye.
See you. Bye-bye.